As always, it's a privilege to be part of the Business World Sustainability Conclave. And a very good afternoon to all of you. Our thanks, not only the panelists, but from all of us who has been part of the jury and everything. We thank you for being here today. In an era or in the last couple of years, the backlash of sustainability and sustainable finance has been quite visible. But you are here today because you believe in it. And you are here today because you still see hope. So thank you so much for being here with us today. To my panelists, very warm welcome. Let me straight dive in. You are all very accomplished in sustainable finance. We do believe that, I think from financial sector, that it's going beyond the regulatory asks. We have to make our balance sheets resilient. We have to make the allocation of capital resilient. So, Leena, my first question is to you. ICICI Bank has taken significant steps in integrating ESG. Am I correct? Yes. And especially in its lending framework. How have you been ensuring that the climate risk stress testing translates into real shifts as far as your credit policies are concerned, rather than just making it a compliance agenda?
Thank you, Chandni, and thank you, Business World, for this opportunity. Chandni, to specifically talk about climate risks, so ESG is a much broader framework where we look at environment, social, and governance. This is something that I think most banks today have already started embedding it as part of their credit frameworks when evaluating credit proposals. Coming to climate specifically, I would say one needs to recognize that climate is deeply grounded in science. There are various, and it is an evolving science. So things are still moving. One needs to specifically understand how one needs to embed climate specifically into credit. And if we are looking at that, you need to have robust data, you need to have robust models in place, which is also being developed. Now, if I have to look at it from an Indian context, database is something, there are several available. But as a bank, what I need to look at, where I need to fall back on. This is something where the Reserve Bank of India has now started talking about building that kind of a data repository, which banks can then start looking at from the perspective of understanding physical and transition risk priorities.
So, Leena, if I may interrupt you there. So, what is ICICI Bank's approach so far? We are very interested into knowing what is ICICI Bank doing in this area.
So, at the bank, we have been evaluating and looking at these data repositories. There are IMD, there are various data science providers. There are startups that are working in this space. We have been engaging with them, trying to understand how to look at emissions, how to look at various proposals, what are the key nuances that one needs to look at from a climate perspective. So this is something that we have started looking at. We have been also, as I mentioned, data is a very important part of this, and for that we have been trying to understand where that data resides within the bank currently, and what are the new areas where you need to start collating that data and information.
Sure.
The other piece is, of course, if you're looking at it, there are various aspects that one needs to look at. One is at a sectoral level, how these transitions are going to play out. So understanding what will be the direct impact, the indirect impact on these sectors,
sure,
and being able to embed that understanding into this, into our frameworks.
Fine.
The other part is at the borrower level.
Yeah.
And the third part, I would say, is capacity building. Internally,
absolutely,
that is a very critical part.
Absolutely. And since you mentioned that, Raakhee, I'll move on to you. GEF Capital Partners is a private equity firm, and you actively integrate ESG into your investment thesis, I believe. Given the evolving climate finance landscape, how do you assess and manage climate-related risks within your portfolio? And do you employ an ex-ante framework to evaluate risks before investments or an ex-post approach to measure financial and impact outcomes at a given point of time? If you
Sure.
can share your thoughts.
Sure. Firstly, thank you so much for inviting me here, and thank you, Chandni, for your question. So essentially, just to give a very quick overview of what GF does, GF Capital Partners, we are a private equity-focused fund investing into climate kind of businesses and projects, so essentially climate mitigation and adaptation. Therefore, climate becomes a very, very integral part of how we think, what we do, and how we execute our portfolios. So essentially, for us, we look at climate from really a pre-investment kind of a focus, right? We typically invest in sort of medium kind of scale enterprises. Our thesis kind of varies from energy efficiency kind of businesses, EVs, renewable projects, etc. And therefore, looking at both physical risk and transition risk for every investment that we do, as part of the DD process. So engaging really with experts, understanding what kind of physical risk, not just at an asset level, but also in the supply chain, because I think that's very, very critical and important to understand. Because if there is a disruption in the supply chain because of climate-related events that might follow through, that's something which we would want our portfolio company to understand, comprehend. And what also happens because we undertake these kind of evaluation and assessments pre-DD, we know what are the sort of mitigation measures that we need to put in place for our asset, and also as a fund, how this may impact in the long run. Now, typically for a private equity fund cycle, right, our investment period kind of is 3 to 6 years, whereas your climate impacts go much, much beyond that. But still, I think it's very relevant and important for us to sort of inform our portfolio companies to be starting to kind of becoming aware of those impacts. So I think it's both a pre-DD and then, of course, a post-investment monitoring approach that we follow. Thank you.
Thank you, Raakhee. That's very succinct. Moving on, Ravindra, thank you for adding diversity to this panel. So really appreciate you adding diversity here in this panel.
Thank you.
BOB has, Bank of Baroda, has integrated climate risks into its ICAP framework. You have an ICAP framework. Now, can you share an example of how this has influenced real lending decisions, particularly in high-risk, hard-to-abate sectors?
Yeah, so first of all, thank you very much for inviting me here. Thanks, Business World. As far as actually incorporating the climate risk or the ESG part into the decision making, I'll say it affects pricing or the decision to an extent. So all the banks, when they lend, they do have a model approach. So you input certain things into your model, and the output actually decides that whether it is an investment grade or non-investment grade. So basis your risk appetite for each of the rating grades, then you decide whether to lend or not. So right now the models, which are actually Basel compliant models, which banks have in place, they do have some component of the ESG, but the weightage might not be that great. So some of the banks might have weightage of 7%, 10%, 15%. But to that extent only it will affect your rating, internal rating I'm talking about, or maybe external rating. And then with the internal rating, the pricing is linked and the decision is linked. So it will have some of the impact, but I'll not say that it will have a huge impact on that. Because finally, the decision and pricing is also driven by the competition. So there is a lot of competition, and previously we have seen from the presentation of the Vinay Pratap Singh ji, what he said about the energy transition of India. By 2030, you are going to have 50% from the renewal, and by 2050, again it will go to 60, and then by 2070, when you become net zero, probably you reach 100%. And you will find our portfolio actually evolving in that sense. So you'll find the renewal portfolio increasing, and I may call it right now exponentially. And when you see the non-renewal part of the portfolio, it is either stagnant or slightly kind of declining. But it
That
is
is
with the industry.
wonderful. Thank
Yes.
you, Ravindra. I mean, that's very insightful to see that the renewable portion of your portfolio is growing, whereas the non-renewable, even though we need coal and oil to
Yes.
still create energy for India, it's getting static or declining. That's fantastic. Moving on to Priyadarshini, HSBC is a multinational bank, so and HSBC, and I know Hitendra, so we were talking about him, he's been a very strong proponent of green finance in India, and he's done a lot of work with some of the biggest associations here. So globally, we are now seeing shifts in terms of institutional commitments to and pushbacks again, regulations, sustainable finance regulations, and also because of market pressure, political pressure. Has HSBC ever reconsidered or rolled back on any of its global alliances or sustainability commitments? And if so, what have been the driving factors for those decisions?
First of all, thank you, Chandni. Thank you, Business World, for inviting me here. That's a very, very relevant question, given all the noise every day we get to hear and read in the newspapers. And coincidentally, HSBC results have been announced just 2 days back, along with a reiteration of our commitment to net zero, in fact. Happy to share that. So HSBC continues to be a part of the Net Zero Banking Alliance. HSBC was in fact one of the founding members of the alliance in 2021. So our commitment to become net zero in our financed portfolio by 2050 continues. Our ambition to support up to $1 trillion in sustainable finance and investments by 2030 continues. So this North Star of, like for an institution, for a financial institution, the maximum impact we have compared to maybe our own operations is actually what we finance, right? Like if I take an inventory of what are my emissions, maybe 97, 98% of the impact comes from what we finance. So this North Star of being net zero in that finance portfolio by 2050 has actually got reinforced. So as a pathway to achieving that, we have published a net zero transition plan last year. We have interim financed emissions targets. So these keep getting revisited and rechecked at various points of time to see are we aligned with where the market is going and where the real economy is going. We have a target to achieve net zero in our own operations, which is, as I said, 2 to 3% of what the impact is. So for our scope 1 and 2, we expect to achieve more than 90% of it by 2030 itself.
Fantastic. Fantastic. Yeah. Thank you so much. I mean, congratulations. Thank you for keeping the faith alive for a lot of us who continue to, hold the banner for sustainable finance. Congratulations once again to you as well as to HSBC. Leena, coming back to you. And I'll probably just have 15 odd minutes left, so really tight, crisp answers, please. So with increasing regulatory scrutiny, and we're talking about regulatory scrutiny, even RBI has started to focus a lot about climate risk and ESG risk. Now, with internal governance shifts that have made certain issues and criteria for the boardroom to set certain expectations on what are the long-term financial implications related to climate risk. How is ICICI and what kind of internal governance modifications are you taking place with obviously the guidance of your board at ICICI Bank?
So at the bank, we have oversight on climate risk under the risk committee right now. And there is semi-annual reporting that happens on an ongoing basis, which is also, in a way, updating the board on the key developments that are happening in India globally, as well as how the bank is aligning to some of those developments. In certain areas, of course, there is also a requirement to embed some of these in the business strategy. So as part of that, there are training sessions that are going on with the relationship managers so that they are also able to engage with borrowers it's not about stopping lending. It is also about understanding how they can be helped in their transition. So what we heard in our panel earlier, where they have been working on some of these areas, these would definitely be something that the bank would consider when proposals do come to us as well. As part of their sustainability journey, are they understanding the risks and the maturity around that? So these are some things that we are doing. The bank has also taken a target to become carbon neutral by 2032 for our own scope 1 and scope 2 emissions. And we are also trying to understand where the emissions are in our finance portfolio. So there are pilots happening around that. There is, as I mentioned earlier, data aggregation that's happening around that. So these are some of the basic areas, and the updates to the board happen on an ongoing basis, and then that's how the strategic direction also comes from there relating to climate.
Fantastic, Leena. And that's what we want to really hear when decisions are being made on capital allocations, is governance hand in hand with the environment and the social side of things as they are evolving. So fantastic, and obviously kudos to you as well. Raakhee, I'll move on to you. Obviously, you're not a bank, but you bring a very different flavor to the conversation. In terms of increasing capital flows that are being directed towards green investments, and obviously the do no significant harm comes with that. Robust ESG benchmarking is essential. Many private equity firms adopt structured frameworks, and some of the most prominent ones are the ILPA's ESG assessment framework that private equity firms kind of abide by. Does GEF Capital Partners have their own internally developed framework to assess this long-term impact, or do you subscribe to some big alliance or some big?
Yeah, thanks. So essentially, when it comes to GF's ESG management systems, right, we have internally developed our own sort of ESG framework, process and policy, and that takes into account some of the leading sort of tools, frameworks, and the guidance that is available. So right from looking at IFC performance standards, ESG requirements, to UN, we subscribe to UNGP, United Guiding Principles for Human Rights. We are a formal supporter of TCFD. We are also disclosures to UNPRI reporting. And also diversity and inclusion. I think that's also very, very relevant and important for us. So I think it's a combination of various frameworks and tools that we have put together and then developed our own bespoke, because at the end of it, I think frameworks, policies, and processes are just theory if we don't know how to operationalize and implement it on ground, right? And I think our real focus and sometimes challenge and opportunity to create an impact as an investor actually comes in terms of how we operationalize and implement ESG frameworks on the ground. Other than having all of this framework with us, we really work with our portfolio companies in terms of developing their ESG function, hiring the right talent, hiring the right management, ensuring that we have a proper environmental risk committee, working with experts, measuring and monitoring. I think some of our colleagues on the panel spoke about measurement of emissions, etc. But even we kind of put our portfolio companies through a decarbonization and net zero kind of a pathway. At least we want our portfolio companies to start thinking about it, right? Because if there is no measurement, then you really don't know what is happening. And that's not just on environmental issues, but all environmental, social, health, safety. Health safety is a big part, especially when it comes to some of the manufacturing industries that we have. So I think it's a combination of both. As GEF, I think really our focus is what is the kind of legacy we leave behind with our portfolio companies and make them much more ESG advanced when we exit from them.
Yeah, and to that point, it's once you're trying to exit a company or you're taking the company for a listing, you need to kind of help them conform to the requirements for a listed entity on ESG criteria as well. So that should not come out as a blue thing for them, and they need not. If you've really built the process throughout over the years, then it's much easier for them to kind of abide with regulations coming out.
One second just there, Chandni, is that because we have been working with the companies to build their ESG processes, Some of the companies who have gone later listing have really found it much, much simpler, easier, and familiar to disclose with the BRSR requirements and things like that. In fact, they are much, they become ahead of their peers when they come to the listing.
Yeah, thank you for shining light on that. Thank you. Ravindra, moving on to you. With initiatives like the Bank of Baroda Earth Green Term Deposit Scheme, fantastic, it's as long-winded name, and partnerships for green hydrogen financing, and that's very interesting. We'd love to learn more. How is Bank of Baroda structuring innovative financial products to unlock capital for climate resilience?
The product side, so what we do actually, we align our priorities to the national missions. So for example, you talked about green hydrogen, and this is first one in the industry itself. So this is aligned with the national green hydrogen mission of the Government of India. And there, if you see the covenants, the kind of like criteria which we have put are very, very supportive, and this creates a very, very win-win situation, because when we talk about like green financing, so it doesn't come with all the kind of like risk-free. There are certain risks, but how do you actually address the risk? How do you ensure that you get your RAROC, appropriate RAROC in that one? How do you actually ensure that your ALM mismatch is managed properly? So all of these actually go into this thing, but definitely we align all products with the national mission. And when you talk about like PM Surya Ghar Yojana, and for example, PM Vishwakarma Yojana, or for some help for the SHGs. So there are a number of schemes. When you go to our website, you'll find all the sort of help when you talk about Mudra. So all of these are actually financed, these are the sustainable finance kind of things. So we not necessarily require the sustainable funding for these sources. Even the normal funding, we have been using it for years together. Now, the unfortunate part is that so far we have not come across with a uniform taxonomy actually where I can put them together. So there is a taxonomy which I have to follow, there is a procedure and use, there is audit certification I have to follow, and then only I can disclose. But when I talk
Ravindra,
about...
for deposits, haven't the RBI come up with a guidance or a framework for green deposits?
Yes, so it's around the green deposits and the green financing framework. So it is kind of like limited in scope. But when we talk about at the national level, the taxonomy, which you find in the Europe, but we don't have yet. And therefore, many of our products and the investment actually, you can't directly classify into and then publish it. True. So you need to meet certain criteria which actually meet the RBI expectation and the SEBI expectation and international framework. And then only you can actually classify.
Yeah, we are a growing country. We'll get there, surely. Thank you. Priyadarshini, moving on to you. Now, with RBI stress tests and this from the RBI's financial stability report that came out in 2024. They did a very deep dive analysis, stress testing, risk analysis model on climate risks. And there were some stark realities that the banks were made to face. I think if I'm not wrong, there was 66% severe risk on bank balance sheets because of floods. There was another 67 or something north of 65 due to cyclones. On a high extreme risk environment, I think the risk was 138% of bank balance sheets portfolio. So those numbers really put somebody, something has to change. What needs to change? So my question to you is, with RBI stress tests indicating 138 surge in climate-related credit losses under extreme scenarios, how is HSBC India, and just the India side of things, embedding transition finance solutions in helping businesses, Indian businesses, to, especially in the hard-to-abate sectors? What are you doing them, and without overexposing your portfolio to the risks?
That's a good question. Thanks, Chandni. So I think where HSBC India benefits is from being part of a larger global network, and having had the benefit of operating in markets which perhaps could be slightly ahead of India, either in terms of regulations or work on climate stress testing, etc. So for us, we have had certain guardrails around how we do business in the last couple of years itself. So we need to operate within the guardrails of what is the opportunity and the risk for me in the transition. So when I spoke about we want to be net zero and we want to support $1 trillion in sustainable finance, one of the 3 pillars of achieving that is actually supporting transition of industries. So, however, we also need to work within the framework of what is the physical and transition risk for me in every credit lending decision I make. So we have sustainability risk policies sector-wise as to how we look at every transaction. So the way we do it is, what we believe is, see, just for context, hard to abate sectors contribute anywhere between 25 to 40% of the emissions, right? But hard to abate sectors are also required for a country's industrialization and development. So the answer is definitely not like shying away from the sectors. The idea is to support the transition. So what we have done is, we ask most of our hard to abate sector clients to share what is their plan for transition from where they are. It could include a combination of, are you working on developing maybe a better process, a better product, greening your electricity, or managing your waste better, whatever it is. Like just explain to us what is your plan for that transition. We take that into account while evaluating both our risk and our opportunity. So we are in fact keen to fund any of our clients who say, I need to invest something to decarbonize. So we're very happy to fund that. We've also done few transactions in India. They'll be one of the first in India, where for these sectors we have said that we will link our funding to certain ESG related KPIs.
I was just about to ask you that.
Yeah.
So if I may, just add as a follow-up question. So one of the good things about banking sector is they can create covenants and they create ESG linked KPIs, use of proceed criterias in how the lending takes place. But could you share an example, and because of your maturity and your global experience as well, could you share an example with us where you have held back a subsequent disbursement or you've withdrawn the lending line because you found the person persistently not meeting the ESG criteria or the ESG KPI? Are we seeing those incidences happening in India as they are now happening abroad? And we all know the global example of Enel in that regard.
So what we do, again, I go back to my lending process. Every time there is a lending decision, one, there is a review of what is the client's transition plan, what it is that they told us and where are they now, and where is it that it seems to be going. So depending on the severity of how it looks, then the decision can vary anywhere from I will exit the client to what can I do more to nudge them into doing better. Our first intent is never to exit the client because we think it doesn't help anybody to just exit. So typically the approach is to then revisit with the client that where are you on your transition plan and how can we support. But yeah, in extreme circumstances,
nudging works. I guess that is what Leena was also talking about. Capacity building internally is one thing, and then we have to do capacity building externally with our partners so that they come up the curve. So thank you so much for the panel, but we are still not done yet. We have another 7 minutes to go. So let me take a little rapid fire round with all of you. And if you can keep your response to less than a sentence, that would be fantastic so that we can cover the questions. So my first question to the panel is, what is the biggest misconception about green finance that needs to be corrected? And let's start from Raakhee.
I think the biggest misconception is... so I think the biggest misconception is if you invest in green businesses, it won't generate returns, and I think that's the biggest misconception.
Fantastic. Ravindra?
So I feel the biggest one is it's kind of risk-free.
Oh, interesting. Priyadarshini?
The biggest misconception sometimes is because a lot of people now talk green, there is a concern of greenwashing in people's minds. So that's a misconception which we are quite conscious of to avoid.
Very true. That's the other side of the story. Leena?
So I would also agree to that. It's more about the opportunities that one needs to look at. It's not only the risk part. There is an opportunity here.
Absolutely. You said it right. To all of you once again, if you could make one immediate regulatory change, I'm giving you the governor's seat right now. If you could make one immediate regulatory change to accelerate sustainable finance in India, what would it be? Who wants to go first?
I think there is a taxonomy required.
Awesome. Awesome, Leena. I've been shouting off the roof for that for a very long time now. Priyadarshini?
It'll take some time to implement, but I would love it if there was a way to quantitatively embed ESG risk into your risk weights. So that it's
How about Basel Pillar 1 having climate risk as part of the reserve
Absolutely.
criteria?
That's my wish list.
Ravindra?
Yeah, so for me, it will be classification into the priority sector entirely. Yeah.
Isn't it already?
So it's to an extent, up to my 25 crores, you can, for example, solar, you can classify, but beyond that, you can't.
Yeah.
So if it
You
is
want-
classified, I mean, I get that advantage.
Awesome.
And it's
Thank
only
you.
renewables, actually. There are so many other sectors that
Yes,
one needs to look at.
absolutely,
Those
absolutely.
need
And
to
the
be-
value chain as
Absolutely.
well.
Yeah, I think India is already trying to build up with their own climate taxonomy. So I think that's something I'm looking forward to. But also one another thing is there are so many frameworks, so many guidelines. I hope we have some streamlining. Most of the audience would agree, I guess.
Thank you, Raakhee. Thank you for that. My last question to the panelists. What is the one green finance strategy your institution adopted that delivered the fastest measurable impact? Let's start with you, Raakhee.
So I think for us, it was really articulating what our strategy was in terms of what was our investment strategy in terms of climate mitigation, adaptation, identifying the right businesses, and we invest in growth capital kind of opportunities. So I think identifying that sweet spot, which really...
Screening, is that what you're saying?
Yeah,
Screening
I think so, yeah.
Okay. What about you, Ravindra?
Yeah, for us, actually, it will be the green deposits. And I think I can claim it's one of the largest which we have been able to actually generate within a span of just 1 year of launching the
How
product.
big is it?
So it ranges into 1,000 crore plus. It is just a very short period of time, even less than 1 year. And I think we are the largest in that space. Yeah.
Congratulations. Priyadarshini?
So I would say two things. One, to define for ourselves what qualifies as sustainable finance and to put a number and a standard to it. And the second, to embed the KPIs in all the senior most management within the bank.
Fantastic. Yeah, the motivation has come right from the employees. So it is so critical. I think many people are missing the bus and they're not able to transform at the speed they want to because it's not linked to the bonuses and linked to the performance of the employees of the organization. So congratulations. Truly, you deserve it. Leena?
So I would also say sustainable financing framework is something that we have been able to articulate and help our employees understand the importance. The other big thing that we see now is employees or our RMs coming to us and saying, this is a sustainable lending proposal, and you need to start looking at it under that framework. That has been a
the
big
movement
shift.
from below
Yes.
upwards. Fantastic. Thank you so much. Congratulations to all of you. It was a very insightful panel, even for somebody like me. I'm sure the audience gained a lot from this. Please stay inspired, stay clued, and please give a good round of applause to your panelists.